Today we're looking at Module 4 under Forex Trading, Fundamental Analysis and Market Forecasting. In the foreign exchange market, understanding how and why currency move is essential for making informed trading decisions. While technical analysis focuses on price charts and patterns, fundamental analysis provides insight into the underlying economic forces that drive those prices movements. By the end of this module, students should be able to define fundamental analysis and explain its importance in forex trading, explain how macroeconomic factors influence currency values in the global market, analyze the role of interest rate in determining currency strength and capital flows, interpret inflation data and explain its relationship with monetary policy decisions, evaluate GDP growth and its impact on economic performance and currency valuation, explain how trade balances and government policies affect exchange rates, describe the concept of market expectations and how they influence price movement, apply structured forecasting methods to anticipate currency movements, explain how forex markets react to domestic and global economic shocks, analyze historical market reactions to major economic announcements, demonstrate the ability to combine fundamental analysis with technical analysis for improved trading decisions. Students should also be able to apply practical forecasting techniques to identify potential trading opportunities before economic data releases. By way of introduction, fundamental analysis is based on the idea that the value of a currency is directly linked to the strength of its economy that it represents. When an economy performs well, it attracts investors, increasing demand for its currency. When economic conditions weaken, investors' confidence decline, leading to depreciation. The forex market is forward-looking. Prices move based on the expectation of future conditions. Currency prices often move because economic events occur, reflecting expectations rather than past data. Fundamental analysis allows traders to understand underlying causes of price movement. It also considers global interconnectedness where events in one country affect others. It is essential for forecasting and decision making. We look at macroeconomic drivers. What are they? Currencies are influenced by economic drivers such as interest rates by the CBN, inflation rate in the country, the gross domestic product, the trade balances, if it's a deficit or a surplus, and the government policies of that country. All these are macroeconomic drivers. These factors determine the supply and the demand for currencies and influence capital flow between countries. Let's look at interest rates as an macroeconomic factor. Interest rates are set by central banks and they influence returns on your investment. How? Higher interest rates will attract investors, increasing the currency demand. Let's say, for example, the Central Bank of Nigeria increases interest rates. Investors want to invest more because they will get higher returns. So their currency, the naira currency, the demand for it will increase. So markets react to expectations, meaning currency may rise before rate changes occur. And let's look at the next, which is inflation. Inflation measures prices over time. How does it affect? High inflation reduces purchasing power but may lead to higher interest rates. Traders will analyze the inflation to anticipate central bank actions. What about GDP growth as a macroeconomic factor? GDP measures total economic output of a country. A strong GDP will attract investment and strengthen currency. Markets react based on expectations rather than actual data alone. So if you predict that so and so will happen, this will happen in the next 6 months, 2 months. This is uh, a market reaction based expectation. Then we have trade balance and government policy. For trade balance, there are two kinds. Either you have a surplus or you have a deficit. The trade surplus will increase the currency demand for that particular currency, while a trade deficit will weaken the currency. Now, why does a trade surplus occur? A trade surplus occur when your exports are more than your imports. The exports you ship out to other countries is more than the import that comes in. It will increase the currency demand of that country. Why a trade deficit occurs when your imports are more than your exports. That means you imported more than you sold. This will weaken your currency of the country. What about government policies? Government fiscal and monetary policies will influence economic performance and investors' confidence. Forecasting Forex. Forecasting involves analyzing economic data and expectations to anticipate future price movement. So forecasting in Forex means when you analyze the economic data that was given, just like those economic factors, and expectations to anticipate a future price change movement. It focuses on probabilities rather than certainties. Now, what are the steps when it comes to forecasting in Forex? One, analyze economic environment. Look at the country you are trading in and check their macroeconomic factors, like I already explained. Secondly, study the central bank behavior. How do the central bank set their policies? Will they increase interest rates? Will they reduce it? Will they set monetary policies that will not favor Forex? You have to study the central bank factors. Thirdly, understand expectations. Understand how to expect. Develop scenarios. You can give up to 5, 7 scenarios. If this happens, this will happen. If this does not happen, this does not happen. You can create a lot of scenarios, a lot of possibilities. Then align with technical analysis. You have checked how to do your technical analysis. Use your technical indicators. Then lastly, create your trading plan to be executed. Now, what are expectations and what do they do? Markets react to expectations versus actual data. If data matches its expectation, reaction is small. Okay, what you expected matches the data that came out. Okay, reaction is small. Or if data differs, strong movement occurs. That means a lot of losses will happen or a lot of profits will happen. We have what they call the pre-news positioning. Traders position themselves before news based on the expectations on it. The concept is you buy the rumor and you sell the news. Market reactions depends on outcome versus expectations. Let's look at some of the challenges when it comes to forecasting. We have one, overconfidence. Two is interpreting data. Three, emotional trading. When you trade impulsively, you don't study trends, you just put your money, you just trade. Four, ignoring the broader context. These are all challenges of forecasting. You can be too confident that no, this thing will pull through, this thing will increase. If it does not increase, it will cause a loss. You can misinterpret data. You are not a specialist or you are not an expert when it comes to interpret data, and you interpret and you trade based on that. You make loss. The emotional trade, like I said, is impulsive. Then ignoring broader context, you don't check other environmental factors. You only look at one institution. These are all challenges when it comes to forecasting in the forex market. Now let's look at economic shocks. Economic shocks are unexpected events that causes rapid price movement. Example of economic shocks are crisis, government policy changes, geopolitical events. They increase the volatility and uncertainty. Volatility is fluctuations. Now let's look at risk on versus risk off. What does it mean? Risk on is when investors take risk. Risk off is when investors move to safe currencies. That's what the term means. Risk on, taking risk. Risk off, moving to safer currencies. By way of conclusion, this module has explored the principles of fundamental analysis and how they apply to the forex market. It has shown how macroeconomic factors such as interest rates, inflation rate, GDP growth, and government policy they influence currency values. This module also explains how traders use forecasting techniques to anticipate market changes and movement, and how expectations play a critical role in determining price reactions. Additionally, it has examined how global economic shocks affect currencies and how market sentiment shifts during periods of uncertainty. At the end of this module, there's an assessment session to test your understanding of this module, 15 quiz, and a report to be written. I'll see you in the next module.